Today is August 18th, and after 38 years, Xin An Electronics has officially disbanded. Hong Kongers are known to believe in feng shui, so the choice of today must have been deliberate. The owner must have been someone who values traditions and customs.
Videos shared online show the final group of employees gradually exiting the factory gates of Xin An Electronics Shenzhen Corporation. Despite losing their jobs, fortunately, all of them received appropriate severance compensation. However, the same can't be said for the workers in another factory nearby. Apart from Xin An Electronics, many other companies also started shutting down on August 18th. Videos uploaded by netizens depicted people moving equipment during the early morning hours in a factory in the Yingbo Industrial Park, Longhua district of Shenzhen. Many employees blocked the entrance. Rumors suggest that the boss was unable to pay wages and was attempting a quiet getaway. However, vigilant employees who were on guard inside the factory noticed and halted his actions. Whether they will ever receive their owed wages remains a question, let alone any severance pay. For the Chinese who consider 8 a lucky number, August 18th should have been a good day. However, Shenzhen's major electronics manufacturer, Xin An Electronics, chose this day to cease operations. Therefore, for the 900-plus workers, this was not a fortunate day, but the day they lost their jobs. According to mainland media, on August 15th, Xin An Electronics unexpectedly announced its early dissolution. This news stunned the industry. Xin An Electronics cited global economic downturn and decreased orders leading to worsening business conditions as reasons for its premature closure. However, rumors suggest that in 2019, its parent company, Simatelex Manufactory Co. Ltd. from Hong Kong, established its first overseas factory in Indonesia. Soon after, some orders were shifted there, potentially revealing the real reason behind Xin An's closure. Public records indicate that Xin An Electronics was established in 1985 as a subsidiary of the Hong Kong-based Simatelex Manufacturing Group in Shenzhen, once employing several thousand workers. Simatelex was among the first Hong Kong-funded enterprises to venture into mainland China. Founded in 1969, this veteran OEM primarily produced coffee machines, beer machines, blenders, massagers, air purifiers, and other household appliances. They were once dubbed the Whampoa Military Academy of OEMs, serving renowned international brands like Panasonic, Philips, Siemens, and DeLonghi. Starting from 2009, Xin An Electronics started to struggle in its business due to many long-time overseas clients shifting their orders to emerging countries like Southeast Asia and Mexico. This was due to skyrocketing manufacturing labor costs, intensifying China-US trade tensions, and unmet delivery promises due to tight pandemic-related controls. Xin An Electronics tried to change by shifting from a 70% export model to a combination of overseas export and domestic sales. However, they ultimately couldn't turn the tide. Their workforce dwindled from over 4,000 at its peak to about 3,000 before the 2019 pandemic, and was down to just over 900 by the time of its dissolution. Like many Hong Kong enterprises in the mid-1980s, Simatelex moved all its manufacturing to mainland China. Apart from Xin An Electronics, they have 3 similar factories in Shenzhen and Qingyuan in Guangdong Province: Xinfeng Electrical Appliance, Xinsheng Electrics, and Simatech Industrial. Presently, these 3 factories are still operational, rumored to take over some of Xin An's orders. However, with Xin An Electronics seeing reduced orders and eventually dissolving, what's the operational status of Xinfeng Electrical Appliance and Xinsheng Electrics? Xinfeng's annual report showed a decline in employees, from 4,809 in 2016 to 3,740 in 2019. In the subsequent 3 years, Xinfeng has not disclosed its employee count or social insurance details. The annual report of Xinsheng Electrics reveals that in 2016, the company made contributions for both basic medical insurance and unemployment insurance for 2,599 employees. This number has gradually declined to 1,667 by 2019. The most recent disclosure of Social Security information was in their 2021 annual report, where they reported contributions for only 274 employees, a drop of approximately 90% since 2016. These figures also offer a glimpse into the recent decline and transformation of Shenzhen's manufacturing sector. The closure of Xin An Electronics is just a tip of the iceberg. Local sources indicate that since the outbreak of the COVID-19 pandemic, nearly all Hong Kong, Taiwan, and foreign-funded enterprises have either left, downsized, or are on their way out. Recently, there were online reports suggesting that the Taiwan-based company Airmate announced its withdrawal from Shenzhen on July 22nd, resulting in over 8,000 layoffs. This news garnered significant attention. Records show that Airmate, originally known as Dongfu Electronics, established its first factory in Shiyan, Shenzhen in 1991, and a second one in 2001. It was one of the early Taiwanese companies to expand into China. Airmate's product range includes electric fans, heaters, exhaust fans, induction cookers, electric kettles, and other small appliances. Their electric fans in particular, hailed as the king of fans, have reportedly been purchased over 100 million times. Their products not only hold a significant market share in China, but are also exported to over 60 countries and regions, including Japan, South Korea, Europe, and the Americas. However, Airmate Electrical Shenzhen Co. Ltd. subsequently issued a statement on their official website refuting the claims of a complete withdrawal as baseless rumors. It's rumored that the individual who spread this false information was taken in for questioning by the police. Yet, a closer investigation suggests that the news wasn't entirely unfounded. In April of this year, an article titled Airmate's 3 Majestic Transformations, Shenzhen's 8,000 Employees Moving to Jiangxi, went viral online. It mentioned that during Airmate's peak, their Shiyan branch in Shenzhen had 8,000 employees and had generated employment for a total of 300,000 people in the upstream and downstream industries. Now, some of these jobs have moved to Jiujiang, Jiangxi province with Airmate, while others have been replaced by automation. In 2014, Airmate built a much larger industrial park in Jiangxi and successfully attracted many of their suppliers and collaborators to the region, thus evading the rising manufacturing costs in Shenzhen. With supporting policies from the Jiujiang government, the Airmate Group decided to transfer more than 80% of its total production to its Jiujiang base. Thus, the narrative of Airmate's withdrawal from Shenzhen and the consequent job losses for 8,000 employees isn't merely a rumor. As of now, whether there will be further developments remains uncertain. The impact of Airmate's move from Shenzhen has been profound. On May 26 of this year, Shenzhen had just proposed the slogan Industrialization of the City, emphasizing the importance of manufacturing to Shenzhen, and introduced 30 measures to encourage the return of the manufacturing industry. If Airmate were to completely leave Shenzhen at this juncture, it would undoubtedly cause embarrassment to the local government. Shenzhen's current push for manufacturing might be a reaction to witnessing numerous factories closing or relocating. The city was afraid of stripping its world's factory title and causing an economic decline, which is why they are now keen on retaining the industry. The truth is, the downfall of a factory, especially large ones, impacts not just the factory itself, but also many related upstream industries and surrounding service sectors, such as restaurants. In the video, the young individual mentioned that they had worked a day's worth of temporary labor and earned $300. When they finished work and approached the employer to receive their wages, astonishingly, the employer claimed to have no money and couldn't even come up with $300.
So get this, he's supposed to pay my wages. And then he goes all like, sorry, no money left. Can you believe it? He couldn't even cough up a measly 100 yuan from his pockets. He's like, I'm seriously broke now. Can't even buy groceries tomorrow. Everyone swipes their credit cards these days. He said he's in a mad rush to ship stuff out and had no choice but to hire this whole bunch of temp workers. Turns out his clients haven't paid for his goods for over a whole month. I mean, seriously, this guy runs a factory and he's sadder than me?
In April, after 20 years in business, Shenzhen's packaging giant Guanda Printing Group faced financial troubles due to poor management and a broken capital chain. The owner reportedly fled overnight. He left behind employees who hadn't been paid for half a year and debts amounting to tens of millions, including supplier payments and rents. Records indicate that Guanda Printing was established in 2003. The company was once a key supplier for various international brands. It began to see a serious decline in performance from 2016 onwards. The subsequent years witnessed numerous large-scale manufacturers gradually leaving China, resulting in the loss of clients for Guanda. Coupled with the effects of the pandemic, the company found itself in insurmountable debt and ultimately had to cease operations. Foxconn stands as a symbolic presence in China's contract manufacturing sector. Over recent years, there have been ongoing rumors about Foxconn withdrawing from China. A recent video shot by netizens featured Foxconn in Guanlan, Shenzhen. It shows that although many are still reporting to work, the number has noticeably reduced compared to last year. According to internal Foxconn employees, the company has faced unstable orders this year and hasn't been engaging in large-scale recruitment like in past years. Surprisingly, workers now have a 2-day weekend and only work 8 hours a day, a practice that was unthinkable in the past. Indications of relocation are evident. 2 of Foxconn's external dormitory buildings are now empty. However, the video also mentions that Foxconn has constructed 2 R&D buildings in the Guanlan district of Shenzhen, and that the company might be facing challenges associated with R&D transformation. This transformation, along with previous mentions of companies like Airmade leaving Shenzhen, brings us to the Chinese government's policy termed birdcage economy, initiated in 2008. The essence of this policy is to replace foundational manufacturing with finance, real estate, and tech R&D enterprises. While many foreign giants may be departing due to increasing labor costs, the US-China trade war, and pandemic-related factors, this birdcage economy policy is another significant reason behind the decline of Shenzhen's overall manufacturing sector, including local enterprises. The birdcage economy policy was first introduced by the Guangdong Provincial Committee in 2008. At the beginning of the reform and opening up period, Guangdong, leveraging its geographical and policy advantages, attracted numerous foreign businesses. This led to the flourishing of its private economy. Guangdong's industrial format was primarily characterized as storefront at the front, factory at the back. Data shows that by the end of 2006, small and medium-sized enterprises in Guangdong accounted for more than 99% of the total industrial enterprises in the province, and their assets represented over 70%. However, this manufacturing-centric economic mode wasn't favored by Guangdong's new leadership, who deemed it as low-end. They desired large corporations, high-tech, and well-planned industrial parks. From 2008, multiple local policies and regulations were issued, compelling governments to remove signature manufacturing units. By 2013, according to Guangdong's third economic census, the assets of small medium-sized enterprises made up only 36% of the total, plummeting from 70% in 2008. Many enterprises relocated their manufacturing out of Shenzhen during this period. Concurrently, Shenzhen began building office towers, prioritizing a headquarters economy. Records indicate that between 2008 and 2016, almost 40,000 enterprises moved out of Shenzhen, including several Fortune 500 companies. The repercussions of Shenzhen's birdcage economy policy were dire. Firstly, it led to the hollowing out of the manufacturing sector. Many manufacturing parks deteriorated. In recent times, with the booming real estate market, many transformed into commercial or residential areas. The vigorously pushed headquarters economy in Shenzhen not only resulted in a high vacancy rate in office buildings, but also spawned many shell companies and fake headquarters to exploit tax incentives. Secondly, it disrupted the entire industrial chain. An industrial chain requires collaboration from both the upstream and downstream sectors. Shenzhen became the manufacturing capital due to the aggregation of numerous small and medium-sized enterprises. With the mass exodus of these SMEs, big enterprises couldn't survive on their own, and many considered moving out. Moreover, investments in manufacturing began to decline from 2019. Government interventions deterred further investments in the foundational manufacturing industry. Another critical issue was the spike in unemployment. Manufacturing serves as the foundation of employment. When manufacturing couldn't accommodate new job seekers, other sectors contracted. This is a primary reason behind the unprecedented youth unemployment wave in China. These events showcase the failure of the birdcage economy policy implemented by the Guangdong government years ago. Amidst a continuing economic downturn in 2023, Shenzhen is reviving strategies such as industrial foundation of the city and strong manufacturing city. However, it may be too late. Foreign capital withdrawal has become irreversible, and new investments seem unlikely. Many factories that were forced out have shut down, and without the support of major manufacturers, relocating back seems improbable. The so-called emerging high-tech industries under the technology blockade led by the US are finding it tough. Hence, the decline of Shenzhen's manufacturing sector appears inevitable.